I want to start with a presentation on part 1. My previous presentation was just a summary, so I want us to recall what we learned from my summary presentation. We learned about risk in Forex investing. What is the risk in Forex investing? We also learned that God himself is a God that breaks down his process into steps. We ask ourselves a simple question like, how will Jesus Christ invest or want us to be investing in the Forex markets? If you don't know the answer, I will urge you to go back to my summary presentation. How will Jesus Christ want us to be handling loans? If we are giving loans, how will Jesus Christ want us to be handling such loan? Well, you will find the answer in Matthew 25, verse 14 to 30. I'm not going to talk about it now, but towards the end of the presentation, not this particular part, the entire presentation, you will find the answer. So let's start with part 1 of my presentation. When is one speculating? This is what I'm going to present in this particular part, in part 1. When is one speculating? We are going to look at the differences between speculation and investing. So the difference between speculating and investing. The main difference between the two is the amount of risk undertaken in the trade. So typically, a high-risk trade or high-risk trades that are almost akin to gambling fall under the umbrella of speculation, whereas low-risk investment based on fundamentals and market analysis will fall into the category of investing. So this is the main difference between the two. One is a high risk, and the second one is a low risk, but is based on fundamentals and market analysis. Let's look at this graph or this image. You are given a lump sum of money. If you divide that lump sum of money into small parts, into small manageable parts, and take small parts at a time to invest, then one can say you are practicing the concept of investing. On the other hand, if you invest all the lump sum of money at once, that is gambling. So low risk, if you do not pay too much per investment. You will be hearing me talking about do not pay too much. This is one of the principles of Warren Buffett. If you do not pay too much per investment, it's a low-risk investment. Investors seek to generate a satisfactory return on their capital by taking on an average or below average amount of risk over a relative long period. On the other hand, a high risk is if you pay too much per investment. You are given a loan, you invest all the loan in the Forex market at once. That is a high risk. On the other hand, if you divide your loan into small parts and invest only small parts of the entire loan, not all at once, then that is a low risk. So I said, on the other hand, speculators are seeking to make abnormal high returns or high profit from fewer but high amount of risk over a relatively short time. The investment can go one way or the other. So if you risk all your money at once, that is speculation. It's not advisable. I'm going to use some examples. It's not only in Forex you find people speculating. Let's take 2 examples. Future promises of richness is speculation. When you have no clue, you have no statistics, you have no knowledge, or somebody is promising you that you will gain in future from a particular investment, you are speculating. So in oil industry, especially when people are doing exploration, we can refer to it as speculation. So the examples I give here is in the case of in Namibia. So I said consider a volatile oil exploration along the coast of Namibia in the past, whereby people were told that there are high chances of striking oil because of similar exploits and discoveries along the coast of Angola and Brazil, which has similar underlying geological formation like the coast of Namibia. So people just woke up, excuse me, people just woke up overnight and started telling people there is a chance that there is oil deposits along the coast of Namibia, simply because the coast of Namibia have some similarities with the coast of Angola and Brazil. So some speculators jumped on such hype and invested in some of the exploration companies, hoping they will strike oil. So when they invested in those exploration companies, they borrowed money. So those who invested in the future prospect and promises by borrowing money to buy stocks of those companies on hunches lost their loan or lost their margin when the exploration did not find any oil of commercial value. So they packed up and go. So those who borrow money to invest in those companies lost their money. That is called speculation, because they put all their margins, all the money they borrowed from the bank, on the promises that there will be oil discovery along the coast of Namibia. So with no concrete evidences of oil deposit along the coast of Namibia, prudent and low-risk investor would tend to wait for those companies doing exploration to discover oil before investing in them. This is because such investment will become a high risk if no oil is discovered. So simple, a prudent investor will not invest until there is an actual discovery of oil along the coast of Namibia. So we can find such similarities in Forex investing. I said similarly, relying on future forecasts of upcoming fundamental news to take a position in the Forex markets before the news is released is speculation. Some people will tell you, say for example, the non-farm payroll, where the Central Bureau of Statistics of US will normally release the employment and unemployment figures. Some people will speculate employment figure will go up or it will go down. If you invest before the news is released, you are speculating. This is the main failure of 95% of Forex traders, because they are relying on mathematical models, also called algo trading or signal trading or robot or automated or event trading, without knowledge of how to determine the impact of economic numbers on the market. They are also called betting on the future state of market conditions. So when you hope that there will be good news or there will be bad news, and you invest based on such hope, you are speculating. That is called speculation. On the other hand, a prudent investor, a prudent forex investor will tend to wait. I take that again. Prudent forex investors tend to wait for the release of news, for the release of fundamental, and then they work out the impact of it on the market before deciding how much to borrow from his or her broker to take a position. So if you are going to be a good investor, you must wait for the news to come out. You work out the impact of the news, and then you borrow money based on the news. You are no longer speculating, but you are investing. So like I said before, when is one investing? An investor must do risk analysis. There is no way you can avoid risk. You cannot avoid risk in forex trading, because in my previous presentation I said risk is the money you borrowed. It's the money you borrowed and how you spread that money you borrowed among different trades. If you put all the money you borrowed in one particular market or in one trade, you are speculating. On the other hand, if you divide that money you borrowed into small parts and you work out the impact of news on each small bit of the loan, then you are investing. So you can reduce the adverse impact of any news on your equity. Let us let us see how people do risk analysis. Risk analysis, to me, there is not much mathematics involved. Of course, there will be a little bit understanding of figures and charts and so on. But the basic thing a good risk analyst should do before choosing, say for example, you want to choose a fund manager who is going to manage your fund, you should be able to consider whether a fund manager returns profits from the forex market consistently every month before you choose a fund manager. You should consider whether the fund manager's business operational risk is low. Operational risk is the determining factor. So operational risk is the lot size or the amount you invest in the market. If it is low, it's a good fund manager. If the operational risk is high, like we have seen already, then that fund manager is not a good fund manager. Of course, there is mathematics, a little bit of mathematics involved. You must be able to calculate this, what is low risk. A low risk to $200 investment will not be the same thing as to somebody having 20,000. 3, you must consider whether the fund manager has a sound excuse me again, has a sound investment knowledge based on tested principles. If the person doesn't understand or doesn't have any knowledge that is based on principles, like me, I said I base my investment in 6, 7, 8 principles of God. Any principle of God is tested, is proven, because it is God that created the principle. So if somebody just comes and say, I have an investment principle, and you just choose that person without understanding the investment principle, you are not doing a good risk analysis. 4, you must consider whether the fund manager has a good understanding of fundamentals. Fundamentals are derived from economic indicators of a particular economy. Say, for example, I spoke about the unemployment rate. We talk about the inflation rate. We talk about job numbers, which is also linked to unemployment rate. We talk about the GDP, the retail price index, manufacturing price index. All of these indicators impact on whether the economy of a country is doing well or it's not doing well. So what time do you invest? Do you invest in when economy is doing well? I will be talking about it later. Or do you invest when the economy is doing bad? That is why I wrote the ebook, Faith in Bad Numbers. Generally, what I learned from Warren Buffett is that you should invest in an economy that is doing bad. When the numbers are bad, you are able to buy at a cheap rate. So you must consider whether the fund manager has a sound technical knowledge of how to read and interpret charts, or execute the right lot sizes that matches the operational risk. So we talk about business operational risk somewhere here. And if somebody doesn't understand how to calculate this and implement such risk from whatever chart they are using to look at the market, then the person is not a good fund manager. In all, a fund manager should have a good track record. This is still part of risk analysis. Should be able to invest in fractals or small portions, and should invest at markdown prices. Markdown prices. So this is how to avoid high risk. When you avoid high risk, or when you reduce your risk, there is a chances that you are going to return profit. So in forex investing, you should find a good fund manager that can return 10% per month on your capital, or at least 10%. Some people will prefer even something like 2%, 5%, and so on. Those who have money to invest, they don't expect too much profit. So if you can find a fund manager that can give you consistently something like 10%, if it's above that, it's fine. But it must be consistent. Not 1 month you have nothing at all, another month you have 50%. So the fund manager should have good strategy to recover from drawdown. This is another, analysis or risk analysis you must do. There is no market that doesn't have spike, that is rapid movement of prices, or crashes, or rapid movement of downward prices. So you must have a good, or the fund manager must have a good strategy on when to recover from drawdown or buy back losses without impacting on your overall capital. So when you find a manager, a fund manager with all of these characteristics, then you can invest to follow the fund manager. You can invest a portion of your money to invest along the fund manager. This is how to do risk, and this is the differences between what I refer to as speculation and investing. So if you are not able to do some basic analysis, and you invest, or you don't have faith in your fund manager, and you invest, then you are speculating based on the hope that you will receive, or you will receive profit from the person managing your fund. I want to show you an example again. This was recorded, the part 1 of this was recorded on the 19th of August. My previous recording was on the 15th of August, I think. So let us see how to follow my investment. I invest using Swiss market platform. They provide me with the facilities. You can visit it. It's full column / GOO, not 0, GOO.GL / small e, small w, 2, capital T, small p, and 1. Just copy this and you'll be able to visit my Fractal Fund Management, which I am operating from Swiss market. I think it is better for me to take you there so that you can see once more. Here we are. Like I said, today is 19th of August. My previous recording was on the 15th of August. My broker is Swiss market. Let's go to the public strategy. Like I explained in my previous presentation, we have different people who are using this platform to trade their strategy. My strategy is Fractal Fund Management Strategy. You can see I am now number 1 in their public platform. My previous recording, I was around 47–48%. I have gained some percentage. I am now on 53.87%, and I have an average monthly return of 14.83%. This average can change, but I promise, let's go to the fund management. I promise those who are following this investment a 10% per month on average. Of course, we have the performance fee of 30%. I started the fund in May with about $900. This is now my own capital, which is $2,619.84 US. I have some couple of people following me, so the fund has now increased to 3,908. You will see some few basic statistics here. I have gained overall over the past 4 months. I started in May, 53%. I started in May. Actually, my equity in May that I started with was around 500, not 900. It was 500. You can see it from the graph here. There was a little bit of drawdown, and then I'm able to move gradually, consistently in lockstep fashion, small steps, not in big step. I am now, having a total fund balance of 9,908. I employ what I refer to as fractal steps. Of course, you can have a balance. This minus here simply referred to as the money that is still not closed, open gain. Even if I close this, I'm still in profit. To see how I trade, let's see the open trades. You will see that I only take a small portion of my equity and trade with it. I use MetaTrader. I will go to that MetaTrader. This is my current open trade. The market is closed now. 0.11 lot size. The total money which I committed into the market is only 165. And of course, I have about 3 trades that are opened. Out of my 9,908, my margin, that is the money. The margin is the same thing as loan. The margin, the loan I borrowed from my broker to execute these 3 trades is just 165 US dollars. So I still have a free facilities. Using my collateral, I still have up to 3,646.6 to defend $165. My margin level is around 2,310%. So which means I have a very big liquidity to defend an investment of 165 US dollars. So thus, this is how I invest, and like I said, I would like you to invest along with me. And I am one of the best anyway. My investment strategy is one of the best on Swiss market, so you should follow my investment based on the link which I gave to you. I thank you for following. You can see I am real, and I will be able to coach you in details as you become a follower of my investment. Thank you very much.